Kalimera Anthropos, welcome everybody to Economica, all about economics and finance, and thanks a lot to all new subscribers, that means a lot to me. Keep following the channel, and if you're new around here, subscribe to Economica. So today we are going to see something very easy to understand, so how to calculate GDP, and the funny thing is that we will see how GDP, gross domestic product, can be calculated with two different methods, and there are more than two methods to calculate GDP. So we will see the gross value added and the GDP, gross domestic product, calculated by prices or economic activity. So here we have the GVA, gross value added, of the UK economy. You see it's seasonal adjustable, millions of pounds, etc, etc. So we will do something very easy. We will take for example, Q1, it was 674.6 million, divided Q4, the monetary value of Q4 of the previous year, 2024, which is 667 million, minus 1, times 100, we will get a number, okay? So we take our digital dashboard here, and we have 1.14%. That's Q1 in gross value added. This is going to be very interesting, so keep watching the video. This is going to be really interesting. Now we will do the same. So we have here Q2, so we do 683.75, if I'm not wrong, 75, okay. Q1 674.66 divided 674.66, okay, minus 1 times 100, and we have 1.35. Okay, let's round it up to 1 point. Sorry about that, I'm using the Mickey Mouse and not a digital pen. 1.35, that's Q2, okay, and Q3 it's 0.9. I know already all the numbers because of my own research, but anyway, we will keep calculating. So here we have, okay, 689.9, is it? Yeah, 689.8. Holy cow, come on. Is there something that's happening to the calculator? What's going on? Mr. Calculator, are you alright? Okay. Okay, let's do it again. 689.89, is that correct? Yes, divided 683.75, same as usual, minus 1 times 100 equals 0.89.7. Let's round it up to 0.9. Now what do we do? As in the same of the short video, we do 1.14 plus 1.35 plus 0.9 equals 3.39, divided 3, we have an average growth. So the average it's 1.13%. What? Well, we could, yeah, let's call it, that's 135, it could be 1.36, so the average is 1.14%, but we are just decimals, okay? Now, the most important thing is that to calculate the gross domestic product with gross value added, we have gross value added plus what? Taxes. That's why Rachel loves taxes. Taxes on products and production, so taxes on products, okay, minus subsidies. Okay, so in this case, if taxes go up, it's not that bad. Okay, that's why Rachel loves, she loves you, yeah. Okay, so we see here the ONS website. So these are the ONS data. We go and try to look for taxes less subsidies on products on production, quarter on quarter. So we have the percentage change quarter on quarter. There is an infinity of measures. So we have 4-quarter growth rate, year-on-year growth rate, seasonally adjust. So we take the most suitable because there are so many different values that we can take, so we have to be careful. And we take the quarter on quarter. So we have 0.41. Let's take our dashboard. My dear dashboard. Okay. Sorry about that. We take our MineLib dashboard. Okay, so we can add the taxes minus subsidies. So Q1 it's 0.41%. Okay, Q2 is minus 0.27%, right? Q2 and Q3 is 0.25%, right? Okay, so what do we do now? We take our GDP 1.14, we want to be generous. No. We do something instead. Sorry about that. I thought I could do it all together. So we do 0.41 minus 0.47. That's how I do it. If it's wrong, forgive me, that's not a problem. 0.39, the average is 0.13, right? So we do 0.13 plus 1.14, and we are at 1.27% GDP growth as an average for the first 3 quarters of 2025. But now, not now, but now, we can easily understand what has been the gross value added in the fourth quarter. So how do we do that? That's not very difficult. We have to do some, how they like to say, back of a fact pack calculation and some simple arithmetic, and we can roughly figure out what GDP growth has been in the fourth quarter. So that's very easy. We know that our growth factor, so our rate of growth up to Q3, including this taxes less subsidy, so at Q3, we are at 1.27. If you go and check the data release from the ONS, also what comes up on the telly, you will see that at Q3, GDP growth rate in the UK was downgraded from 1.5, the aim of the government, to 1.4 or 1.3. So we are exactly in the ballpark, of course, because we are using the same data. We are exactly in the ballpark of the GDP growth that you see on the telly. It's exactly the same, but we are using the gross value added. So now here we have the gross value added. What do we do? Basically, we take the Q3 monetary value, which is 689 billion pounds, because it's in million. These are thousands in millions, so it's a billion pounds, etc. We multiply by our growth factor. Sorry about that, because we need 1.1.27. Okay, so we could presume more or less that Q4 growth in monetary terms will be around 698 billion pounds. Okay, so what do we do now with the drunken sailor? What do we do with the drunken sailor? What do we do with the drunken sailor? So we write down our Q4 theoretical monetary value, which is, what do we do with the drunken sailor? 698.65, okay, in millions of pounds. Now, what do? We take basically the sum of the first 3 quarters, we sum up, and we find out what the heck. So we have 0.66 plus 683.75 plus 683.75 plus 689.89, 689.89. Okay, then we add back up our projected Q4 plus 698.65, and we get to the gross value added for 2025. It could be roughly 2746. That would be 2,746,950,000,000 pounds. Okay, that's basically it's the would theoretically could be the final the 2025 gross value added for the overall economy. But bear in mind that this number we are extrapolating by using the growth factor that we calculated previously, which is 1.27 or 3%. Okay, we multiply by the latest by Q3, we get the monetary value, and we try to figure out what is the gross value added in pound term. So we can try and do another thing. Take our theoretical value, 698.65 divided 689.89 minus 1 times 100, and we get to, again, 1.27, okay? Which would be, in theory, the percentage growth rate. Okay, let me shorten this. Okay. So our gross value added growth for Q4, it's 1.27%. And at the end of the day, we can try and figure out, which is the same here. Okay, this is accounting for the taxes on production less subsidies. So we eliminate this. I know it's a bit of a mess, but we are doing some very easy thing. So we do plus 1.14 divided 4. No, I made a mistake. I don't need to do divided 4 because it's already in on average. So we have 1.27. No, okay, I made a mistake. So we do quarter on quarter. 1.27 plus 0.9. My bad. Plus 1.36 plus 1.14. I have to sum all the quarters divided by 4, and I get to an average growth of 1.16, 1.17. Okay, so let's do some order. So we have that our Q4 average growth is theoretically 1.27, okay, more or less, and that the average gross value added growth for all 2025, so average GVA in 2025, let's call it 1.18%. Okay, I want to be generous. Let's round it up. It's horrible. Okay, let's say, okay, 1.18%. Let's make it larger, but it's 1.17, 1.18%. Okay, so now we need to add back the taxes on production less subsidies, so this bit, okay, to have our gross value added average growth in the year, to have the full gross domestic product data that we want to have. Now we don't have the Q4 tax less subsidies product data, but we can try to do the same and figure out how we can add back the data that we need. We can try to figure out, and as I said, we have different measures of the same item. So here, that's the ONS website. We have taxes less subsidy, that's quarter on quarter, but these are the national account time series. Otherwise, we have the economic account time series, and you can notice, so here, these are the data that I used, 0.4 minus 0.27, and plus 0.25. But if we go on the other page, here we have 3.9 minus 2.5, 2.4. So we can extrapolate sort of, okay, that's 3.9 minus, okay, 3.9 minus 2.5, okay, 3.9 minus 2.5 plus 2.4, okay, plus 2.4, very easy, divided by 3, so we take the average, and it's 1.27. So it seems that this 1.27, it's a consistent data that we find across different measures. So we want to write it down, if I can. Okay, I take some space. So if I take the UKEA, the average tax and subsidies, tax on production less subsidies, it's 1.27%. So If I take the average of the quarter-on-quarter of the national account, I do 0.41 minus, still it's quarter-on-quarter variance, growth. Okay, it's the average, it's 0.39 here. Okay, so for our final figure, we want to use the 1.18. Okay, the thing is gone totally haywire. We want to use the 1.18 figure. So we can, if we add back the smallest data, basically we get to the 1.5%. So the UK government, Rachel said, okay, we want to grow our target of economic growth for the year, it's 1.5%. So it's very easy. It's 1.18 plus 0.39, okay, and you get to 1.57. Okay, let's call it 1.6, 1.57%. Okay, so, but if I take 1.18 and I add it to 1.27, that's another ballpark figure. And let's do it quickly. Of course, it's 2.45, I believe. 1.18 plus 1.27. Yeah, it's 2.45. So we see how GDP growth, the gross value added calculated on with this method, GDP growth calculated with this method of the gross value added should be exactly in line with what the government projected. 1.57, 1.6, 1.5%. But it's very interesting to see how the UK economic account time series, so the UKEA of taxes on products and production less subsidies, it mirrors more or less with an average 1.27% in 3 quarters what results to be the average percentage gross value added plus the national account time series for the tax less subsidies on products. I hope you understood what I'm saying. So basically the average of this time series here, which is taxes on products less subsidies, it's the sum of the average of GVA plus this one, which is from the national account. Okay, you see, quarterly national account Q&A, taxes less one instead. This one, it's UKEA, so economic account, which basically it has a more frequent, they have more granular data. There is more data coming in with respect to the national account, which basically it does not measure exactly in real time the business cycle. So it's this time series, tendentially, it should be more precise than the national account. But at the end of the fanfare, I do expect that for 2025, GDP growth would be UK. It's 1.52. I know it's really horrible. I should get myself a board and a pen. Okay. So I think it won't be so dramatic unless there is something that I'm not aware of, because data are not coming in, are not ready yet. We will see it at the end of February or March, something like that. But anyways, so we calculated, these are taxes. Okay, this is this bit. Okay, we take the average. Okay, so we take the percentage change quarter on quarter gross value added, and we add the average of the tax less subsidies on products and production. So we are adding the tax and we are subtracting the subsidies, okay? Because subsidies is the money that the government pays out, taxes is the money that the government takes in. So we have Q1, Q2, Q2, Q3. We take the average, it's 0.39. We add it back to our average growth of 1.18, and we get to 1.57. So I do expect that the 2025 GDP growth, it would be around 1.5%, hopefully 1.6%. Now, that's the gross value added method, okay? And let's put it here. So GDP with gross value added method, gross GDP, it's GVA plus tax less subsidies. Okay, so now stepping aside that squiggle, let's go here to Italy's numbers, and we find another thing. Okay, so here we have the GDP growth for, okay, let's write it down, the two methods again. So we have seen the UK growth for gross value added, GVA again, once more, plus tax on production minus subsidies. Okay, now here I will translate it from Italian to English. We have the economic account. So we have basically the all the resources, which are the GDP plus the balance of payment. So we have the classic GDP formula, which is consumption plus investment plus the government plus the net balance of payment, which is export minus import. Okay, that's the classic GDP formula that we can utilize to measure GDP. And you see how these are different. It's it's truly interesting for me. So here we have the classic economics 101 formula, which is consumption, investment, the government, and the balance of payment or trade, so export minus imports. And we are not taking, you can see here, we don't have the tax component. While instead for the gross value added, we have the tax component into the business cycle of the year. Okay, so here I found something also really interesting. What it's interesting is that if we utilize the formula, okay, and we sum the individual boxes here on the Excel sheet, we find that the sum does not equal the total. That's very interesting. That's here, okay, that's ISTAT, okay, this ISTAT, with the Institute for Statistical Collection of Data in Italy. There is an open portal, you can access all the data, you can access the website, I believe, in English as well. Okay, so anyone can go and access the data, no problem, although there is, you need to be familiar also with the SDMX language, which I'm not used to, so I find it really, and that's another thing. I mean, the Italian, they are so pernicious about stuff, because, okay, if I put it in Italian, it's so annoying. No, it's not annoying, but you see here that we have the GDP growth data, okay, and we have conjunctural variance of GDP and tendential variance, which is nonetheless to say that the conjunctural, it's quarter-on-quarter growth, and the tendential is the same quarter, it's this year quarter growth compared to the same quarter the past year. So one is year on year, one is quarter on quarter. So I don't know why they use this conjunctural, tendential. I'm not that would be easier, which is quarter on quarter or year on year, and it's much easier. But anyway, so for ISTAT, the sum does not equal the total. Okay, so here we have resources, okay, so which is the sum of the GDP in monetary value, let's call it gross value added, plus the imports, because all the resources that the economy has is the domestic production plus the imports. Okay, that's the total, the sum of the resources that I have at my disposal to do economic activity. Okay, so here we see resources are for Q3 in 2025. They were accounted for let me okay, big it up. Okay, big man. Why big man? Okay, so 626 billion. Okay, but if we sum B12 and B13, okay, here, okay, it's 626.0 something, which is less. Okay, so the sum does not equal the total. So if we compare this with this, okay, we have two different numbers. And if even better, if I sum here, if I do B17, B20, B21, okay, which means I'm summing the final consumption of the government plus fixed gross investment plus exports, I do get 632 billion for all resources, which is way more than 626 billion. That's for resources. Okay, now you can see here what I call PILU, because we all need more PILU, for everybody. So we see here B12, okay, here, that's GDP, prodotto interno lordo, a prezzi di mercato, so it's current prices, but the data is not seasonally adjusted. But anyway, I only take a table because we have another table which is the same data, but it's corrected for the calendar variations. That means that if some months they have more working days, then we want to basically filter out all these these error noise in the days, the calendar. So it's the calendar here. There may be some months that have working days difference with the previous year, so forth and so on. So that's another complicated stuff. But I did the same calculation. You see here how the resources here are 624 billion, and if we sum this and this, we get 625 billion. So the sum does not equal the total. It's a total bollocks, anyways. But what we are observing here is that we are measuring GDP by what? By expenditure, national expenditure for consumption of the government, plus consumption of families, plus investment, plus exports minus imports. Okay, so we are using this method. Okay, and we don't have the variable of taxes. So here we have that in Q3 the gross domestic product was 486 billion, but actually if we sum the boxes here, we find out that probably it was 493 billion, so that it's somewhere around 6 or 7 billion less in the national account figure. I don't know what is the discrepancy between the two, but again, the sum does not make the total. This is fantasy arithmetic for the for ISTAT. Okay, so and it's fantasy arithmetic for me, but anyway. There must be an explanation which probably I've not read of, but I believe that the difference... Okay, let's see here. If we sum the final consumption, which is the sum of the private consumption plus the public consumption, okay, and we sum the fixed investment, so we sum 365 billion and change plus 113 billion and change of fixed gross investment, and we sum exports, 153 billion in exports minus 133 billion in imports, we get to 493.2 billion in gross domestic product, and the prices are measured on the 2020 base year chain measure. so which are valori concatenati, so these are chain value measure, and the base year is 2020. Okay, so we see here altogether, okay, we get to a final sum of 493 billion. Okay, and we can do it for each and every quarter going backward in time if we can time travel, and we see that there are differences from the raw data here, and if we go and sum each box, each economic data in aggregate, if we sum it, we get to, so I presume that they can use these discrepancies in the sum to revise up or down the GDP according to what suits them is the propaganda narrative of the day. And I used another method, and so if I sum, instead of taking the B17, so you need to understand that this one, final consumption on an aggregate national level, is the sum of family consumption plus government. Okay, so instead of taking the whole number, because I don't trust the whole number, I do sum this, which is private consumption plus government consumption, and I sum this gross fixed investment, and I do the net balance of trade, which is plus exports minus imports. Still I get to a different number, which still is 493 billion. Okay, but here, okay, you can see here how, for example, in Q2 2025 we have 490 billion theoretically, and the gross domestic product was reported at 486 billion. So we see that gross domestic product in 2025, Q1, Q2, and Q3, it's steady at 486 billion, while instead if we do the sum item per item, the gross domestic product, it's around 490, 491, 493. And we can do a simple average, 491. So we start from Q1, okay, we take this one, 0.036 plus 490.025 plus 493.325, and the total is 1.1,474 billion. Let's do divided by 3. So the average growth is 491 billion per quarter. And so at the end of the fanfare, again, because it's really funny for me, we found out how to measure GDP in two different methods. Gross value added, whether it's perhaps UK GDP, although we can use the national account methods. And here we have the conto economico of the resources and impieghi. I don't know how to translate it in English. It doesn't come up on my tongue right away. So we have the classic GDP formula, which is consumption plus investment plus government expenditure plus the balance of trade, which is exports minus imports. So so we see here, I invite you all to visit the Istat data portal to get to see the latest economic data. So you see how Italy is growing quarter on quarter compared to previous year, 0.8, 0.5, 0.6. But if we see the quarter on quarter, not by not year on year, but the quarter on quarter growth is 0.3 minus 0.1. 0.1 is really flat. So economic growth is really it's flat quarter on quarter. It always has been. It's the two main factors, which there are three. Okay, so now I will tell you what are the three main factors. So it's youth unemployment. It's a big draining. It's like moving a car. You have driving a car with a handbrake. So high youth unemployment, especially in Italy, it's a dampening effect. It dampens potential GDP, and it dampens real GDP. Another factor which is constraining of the economy in Italy, it's the low investment in R&D. R&D, and in university. And these two are interlinked, because a lot of people who have high degree education and PhD sometimes, or quite often, many bright Italian researchers, they are scooped from the into the United States, or in the UK, in Germany, in Switzerland, in France. So all that brain power, or the capital, human capital power, which is brain power, knowledge power, it's sourced out to other countries. And so the potential of gross domestic product, it's highly constrained. And so youth unemployment and low investment in education in aggregate, from the basic education to degree and R&D research, there is such low level of investment that it's a negative dampening effect on potential GDP and real GDP. And another thing which is very truly interesting, and it explains this lack in the Italian economy, is that when we have GDP going up, okay, it has a neutral effect, is the same of CPI. So inflation, it does not move because of economic growth. So the pass-through effect of economic growth on inflation, it's 0.1, it's muted, it's very little. So that this implies that you have spare capacity. So it means that still there is R&D available that is not utilized. You have underutilization. Let's not use spare. You have, I think it's more precise to say that you have underutilized capacity into the economy. So it means that there are parts of the economic resources in the country which are not utilized, or they are underutilized, and so the potential GDP, it's dampened, it's constrained, and with that real GDP, it's constantly constrained, because the potential, the V12 Ferrari engine, it never goes full throttle, it never goes all cylinders. We are always constraining the potential economic growth, and with that constraining the real GDP growth. And these are choices made in Rome, which are wrong, of course, because when it's politicians that they want to decide about the private life of all the other people, they always make disasters, okay? Whenever it's the UK, Italy, Germany, the problem is the political class, which they don't have the farthest clue of what is science, what is economic science, what is research and development, and what is physics, mathematics, so forth and so on. They are paid 10, 15,000 euros a month for uttering words night and day. So whenever we keep underutilizing the youth part, the youngest part of the population, that means people who come out from school and they don't have specialized skills to work in industry, okay, and they know that. Otherwise, even worse, okay, if we have people who have a high degree, who do PhD research, and we give them a 3-month, 6-month, 12-month contract with salaries which are starving salaries, a little bit more than 1,000 euro per month, so you can be really, really, really sure, okay, and we keep dampening investment in education and in research, you can be assured that gross domestic product in Italy, it always will be crap, okay, and we will never develop the potential of the human capital, okay. So it doesn't matter a cent to me that these people go around and say, okay, well, we have Leonardo da Vinci, so forth and so on. Yeah, he was very, really bright, because Leonardo da Vinci didn't need any computer or any AI support. So those people, they were way, 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 way better than us. Okay, and so the real stuff is that we keep doing the same mistake over and over and over again, and it's all due to those damn politicians who are ruining the life of ordinary people, and they racket up thousands and hundreds of thousands of euros every year and every month. Okay, so if you want to fix the Italian economy, if you want to improve the Italian economy, you need three things. A series of measures for the labor market. Okay, so you need to put in place a series of measures which create more and more employability. You need to have skills training. You need to have training in skills for the workforce, which is from 18 to 24, 25. They either go to a good university or they come out of school and they do some technical training to go and work in a manufacturer or in an industry, even in agriculture. Okay, and you need to invest in R&D. You need to invest billions in research and development. And so you will see that economic growth will start to go up, because it's only when you invest in R&D and in university that you have technology advancement, because it's higher education which generates, which materialize those technologies which improve the rate of growth into the economy. And so with that, I love you and leave you, and subscribe to Economica, and I will see you to the next episode. And I will say that I'm not associated to anybody, not any association or any economic think tank, nevertheless, never ever ever associated to any political thing. No, I'm not. I'm an independent person. All you hear in this channel, it's all comes all from my studies, which by no means are perfect. And the only thing that I know is that I know nothing.